So let's look at personal taxes first of all. Income tax and NI. Are there going to be any changes?
So I think you can pretty much assume that we're going to have the stealth tax. So that's where you don't get a tax rise, and that therefore means that the Chancellor keeps with the pledges that were made in the manifesto of not raising taxes on working people, but instead they freeze the allowances. So the proposal that has been put out there is to extend the existing freeze on the income tax personal allowance, which is currently £12,570, and the higher rate threshold of £50,270, freeze those beyond the current 2028 end date and extend that freeze to possibly 2030. And the reason they will look at that is because it could potentially raise between 8 billion and 12 billion a year. I mean, the numbers that you see in these projections vary massively depending on who is actually making the projections, but it does mean that they don't break that manifesto pledge. What it does also do, though, is it pushes more and more people into paying tax for the first time or into that higher tax bracket as their wages rise with inflation. So that's that tax creep. And there's also been the term I've seen used called the pensioner tax trap, because the issue is that as we have the state pension increase with inflation based upon the triple lock, that potentially by 2027, the state pension could exceed the personal allowance. So that would mean that a pensioner that only received the state pension, they had no other means of income or pension, would be dragged into paying tax for the first time. Now, that is the most likely thing we're going to see announced in the budget when it comes to income tax.
Okay, so what about this 2p switch? I'm hearing about this tax switch where you're going to raise income tax by, say, 2p, but then cut national insurance by 2p. How will that work?
So this is called a 2p switch. I mean, it's 2p in the pound. And the idea is that they will cut the rate of national insurance by 2p. So effectively, they will reduce national insurance by 2%, but they'll add that onto income tax. So you might be thinking, well, doesn't that just mean that it's a neutral swap and ultimately that they won't raise any more money? But what it does do is that it generates another £6 billion a year potentially, because the base that pays income tax is much broader than the base of people that pay national insurance. So you've got to think about it, that will mean that people like the self-employed will end up paying more income tax. Pensioners, because don't forget, people don't pay national insurance once they get past state pension age. So if you reduce the amount of national insurance that's being charged, but you increase the amount of income tax, well, pensioners will pay more tax because pensioners pay tax on the state pension and their own pension income. And also it means that landlords will crucially end up paying more tax because they will pay tax on their rental income. At the moment, there isn't national insurance on rental income. So what the switch will ultimately mean, there will be working people. I hate that term, but I'm going to come on to that in a minute to explain it a little bit more, because it's a very vague term that's thrown about. But there will be lots of people who are working who won't pay more tax because of that switch, but there'll be a much wider group of people who start paying more tax, and that is not national insurance, it will be income tax.
Right, Damien, you said you were going to come back to this earlier. Let's talk about it now. Working people, that phrase working people, which you and I both hate. What does it mean, and can you provide more context?
So the issue is that the government has pledged not to raise tax for working people. But what do working people, what does that mean? And what we're seeing potentially, or there's rumours of, that the Treasury will start to define what a working person is. And the rumours are suggesting that the definition of a working person is somebody who earns up to £45,000 or maybe £46,000. Now, if you earn above that, you're not a working person. And that means about 30% of workers will fall outside of the working person definition. And in some sectors, the average wage, so if you take finance, for example, is above that definition. So they are going to be excluding a lot of people from what is classified as working people. So this is just a clever fudge, a political cover to be able to raise taxes and claim you are still sticking to your manifesto pledge. So I say this without any political judgment at all, but that is a way of slightly moving the goalposts and meaning that you can try and pull the wool over people's eyes slightly by saying that they aren't backing down on the pledges or making any kind of U-turn. So that is a distinct possibility. Now, the other thing that you could have, which would be probably the least likely of the things that I've mentioned, is a simple raise in the income tax rate. So you could have a straightforward increase of 1p or 2p in the pound to income tax across the board. Now, that would be a very good way of raising tax. So you probably get another £8 billion a year, and it could go quite a way to plug in the gap in the public finances that are going to be projected. But it would be a complete U-turn by the government, and I think that is probably the least likely thing we're going to see. But the government hasn't stated recently that that definitely won't happen. They've opened the door. The press conference we saw this week with Rachel Reeves seemed to leave the door open to that potential choice, but also Keir Starmer didn't come out and categorically refute the fact that they would end up raising income tax across the board. So that is one that has definitely come back onto the radar of potential things that could be announced in the budget on November the 26th.
Okay, so what about taxes on wealth and capital? I've heard this emigrant tax that's been bandied about. What is it, and is that likely?
I mean, this is a tax that's been proposed. It's not one I've seen as widely backed, but it's one that where there would be a 20% setting up charge levied on business assets of wealthy individuals at the point they emigrate to a tax haven. So you can potentially leave the UK and sell assets, not property, but sell other assets without paying capital gains tax in the UK. Now, this is a policy that might be politically positive, so it might be well received by the public, but it wouldn't go a long way necessarily to plug in any gaps in the public finances. Some estimates say it would only raise about £2 billion a year. The one issue they do have, though, is if they did announce this and they announced it would come in at a future date, let's say at the start of the next tax year, then you could potentially see a flight of wealth from the UK as people try and move wealth out of the UK and avoid tax. So that is something the government wouldn't want to happen, because the government wouldn't want to see a movement of capital out of the UK.
Okay, what about capital gains tax? Is it likely there'll be any changes to capital gains tax in the budget?
So capital gains tax has been changed in recent years. We've seen the rates go up. Now, there's a number of think tanks out there that think that capital gains tax rates should be aligned with those of income tax rates. Currently, you pay 18% capital gains tax if you are a basic rate income tax payer, and 24% if you are a higher rate taxpayer. Now, they are the general rates. There are some nuances in that, but what they are suggesting is that we could see some equalisation whereby we get the CGT rates equate to 20%, 40%, or even 45% based upon your income tax level. So that could be an increase that we see higher capital gains tax rates. If we did see a change, it would represent a major structural reform based on a fairness principle, that we'd start to tax people on their wealth, their assets, rather than their income as much. So that shift could be politically popular, but it would require quite a major shift structurally.
Okay, still on taxes then, are there going to be any likely changes to the inheritance tax rules in the upcoming budget?
So some proposals that have been put out there are the idea there could be a new lifetime cap on the total value of tax-free gifts that an individual can make and give away. So that figure could be as low as £100,000. I've even seen speculation it could be as low as £50,000. So that would mean a significant change, and it would also increase the amount of tax that people who are wealthy would have to pay in terms of inheritance tax when they were making gifts potentially. So the other is that we could see a change to the 7-year look-back period when it comes to inheritance tax. So at the moment, if you make a gift and the person survives 7 years, there's no IHT to pay. So we could see that change where that look-back period is extended from 7 years, say, to 10 years or even more. So that would mean that potentially more gifts that have been made by wealthy people could be caught by inheritance tax when they die.
And just a question on that I've thought of, if you're extending that period, say to 10 years or beyond, would that mean that more people start giving away money earlier, and what impact would that have?
The simple answer is yes, I think we would see a change in behaviour. We've already seen that when it comes to pensions. So Previously, or currently actually, if you have a pension, you can potentially pass that on to your children, for example, free of inheritance tax. Now, I'm not getting into the rules of that, but that is changing from April 2027 when pensions start to fall into the inheritance tax regime. So they will be inheritance tax on pensions going forward. Now, that has changed behaviour, the way people are dealing with their pensions, they're drawing money out, and also people thinking about IHT more. I think if there is a change to the look back period, then there will be some people that might make gifts earlier, but it will make estate planning more difficult generally, because it will mean more gifts are starting to be captured and paying a 40% IHT rate potentially. So there will be more people probably demanding the needs of people like financial advisors to plan for inheritance tax and tax specialists to help them. But I think it will mean it will be more difficult for them to pass on their wealth without there being some form of inheritance tax.
Okay, so sticking with taxes, but moving on to property, any changes in what's been proposed in terms of property taxes?
There have been calls for a wealth tax to be introduced. So wealthy people being taxed on the assets they have, because generally speaking, wealthy people are able to use their wealth to grow more wealth and produce income, but tend to pay very little when it comes to income tax or capital gains tax. They can mitigate it. So they want a kind of wealth tax to be introduced. Now, there's always been this view that the government would try to introduce this, or should, but the reality is I think that's quite radical. And one of the things that has been rumoured to be introduced instead as a kind of nod towards a wealth tax is to double the council tax rates for homes in the top two bands. That's band G and band H. And therefore they will pay more tax. The benefit of doing that is that the system for taking that tax, so council tax, already exists, and the banding already exists. So it's a much easier thing to implement than a radical wealth tax, which some people are claiming that if you impose a wealth tax, you'd see all the billionaires leave the UK. Whether that's true or not, I don't really know. But this is much more likely than a radical wealth tax. They would probably call it something like a mansion tax, judging on the fact that it was people in bands G and H that would be hit, but it would therefore likely hit people who were professionals as well, so people who live in London and the South East, not just the super wealthy. Now, the other proposal that had been getting some airtime, which has quietly seemed to disappear as we get towards the budget, was the idea that they would start to tax people based upon the size of their house, how much it was worth. And there were even ideas that houses above a certain amount, whether it was at one point suggested as low as £500,000, others when it was above, say, 2 million, they would be taxed an annual tax based upon the portion of the house value above that. But that would be incredibly difficult to implement. How would they collect the taxation? How would they judge it? Because don't forget that when it comes to council tax, it's still based upon a system which had the valuations based upon house prices back in the early 1990s. So the banding probably needs to be reviewed anyway on council tax. We could see that as part of this change, a movement to try and increase the council tax for certain people. We might finally see a review of the bands of houses and the values of them as well.
Yeah, that is a really radical way of potentially introducing that, to do it on the valuation of houses. I'm just thinking, logistically, how would that happen? And what about people who potentially are falling within a certain banding, if you like, in terms of valuation, but then they make improvements to their property, but then as a result have to pay more tax? Would that stifle people wanting to actually make improvements to their property, which could impact the construction industry? It seems mad to me. It's a crazy idea.
All of these things they have to consider in the round, and I think that's another thing that we'll come on to when it comes to stamp duty as well. One of the things with stamp duty, it does stop people moving house. It does limit the free movement of people. Now, there is going to be potentially changes to stamp duty. So one idea was that stamp duty would be shifted from the buyer to the seller. Of course, that has particular issues. If people wanted to downsize, how would that work? We have issues with people being in properties that they're old, they've got very large properties, but there aren't enough homes for maybe family. So would we get the property market stagnate? I think we could if stamp duty was completely removed. That has been one thing that's been suggested. Then that would mean that people would move more freely. A mobile workforce is good for the economy, but it would actually probably be bad for construction as well, because people would therefore just move rather than therefore build and change their own home. So it all has to be thought about. There's lots of reasons why things would work or wouldn't, but would we see stamp duty removed? If we do, I'd be amazed, because it would be such a radical change, something that lots and lots of people, and we're talking about think tanks as well as journalists, have been calling to be removed for quite some time. So it'd be something that would be popular, but of course it would impact the tax take from stamp duty.
I think it's incredible the way you've explained that and all the different moving parts. And those think tanks obviously are very important for the work that they do to ensure that they make the right decision. And so keeping on that theme of taxes on property, what about landlords and national insurance? Any changes expected there?
So one predicted change could be national insurance being applied to rental income for landlords. So buy-to-let landlords might have to pay as much as 8% on that unearned rental income. So it would bring it more in line with earned income. So that could bring in maybe just over £2 billion, it's projected, a year for the government. Whether they do that or not, we'll have to wait and see, but it is one idea that is being touted.
And so what about business and corporate taxes? Are there any changes expected in the budget on those?
So there again have been rumours. Whether these will happen is yet to be seen. So there could be a new tax charge on limited liability partnerships, so LLPs. So these are common amongst lawyers, accountants and consultants. And it means that they are treated as self-employed and therefore don't have to pay national insurance, or sorry, employers' national insurance. Now, this is seen as a bit of a perk. Some people call it a loophole. Either way, it means that they may look at that to try and equalise the tax treatment, and that could raise £2 billion. Again, it's not a huge number compared to a apparent hole in the public finances, but that might happen. One that I've just seen today that's been almost refuted, it's a tax on banks. So there was speculation that there might be increased tax on the profits of banks, and that has now seems to have been, by the FT, reported that that is no longer being looked at. Now, there is speculation there could be an increase in taxation on the profits of gambling companies. Now, I think that would be popular publicly, but of course you have to remember that gambling companies do have a significant influence on the UK political scene. They do donate large sums of money, so in reality I'm not sure how likely that really is.
Okay, and what about VAT? Are there any changes proposed in the budget coming up?
So rumours suggest that there could be a removal of 5% VAT on household energy bills. Now that would be popular because the Chancellor could claim that they are trying to reduce the cost of living. So a removal of VAT on energy bills would actually be a tax cut. So they'd need to plug that hole, which is obviously going to be difficult anyway. Now, while this would be a very fast and simple way to help the cost of living pressures, the one issue is that it also helps people who spend more on energy, so therefore the wealthy. So the more money you spend on energy, the greater that removal of VAT, that 5% VAT cut, would have on your bills. While on the subject of VAT, the VAT registration is potentially going to be looked at. There are rumours that they may cut it from £85,000, which would mean that more businesses would end up having to pay VAT. Some estimates say it will be tens of thousands of small businesses and sole traders that will be pulled into the VAT system. The one issue, of course, is that that would then potentially be passed on to consumers, which could push up inflation.
Okay, so let's round up this pre-budget special. We've looked at taxation. Now let's move on to savings and pensions, because that's always a hot topic.
There always seems to be a rumour around changes to ISAs and pensions when we get to a budget. And most of the time, none of them actually come to fruition. So the first one is the cash ISA allowance. It's been rumoured that will be cut from £20,000 to as low as £10,000 or even £4,000. Now, that would potentially push more people into having their savings taxed, but I think it's really been looked at as a kind of policy lever to try and encourage people to start to invest in the UK economy. But that won't necessarily make people do that unless they create some kind of weird rule that makes an ISA that's almost a British ISA of some kind, or rules that encourage people to start investing in UK companies. So that may be tweaked, but it would be quite a reform, and it would be very unpopular because some of the people who have the largest cash balances and use cash ISAs are the elderly, so pensioners. So that wouldn't be particularly popular. Now, there has been some major pushback, particularly from building societies, because the money they get from cash ISAs, so the deposits, are often used to be able to fund the mortgages that they give to consumers. So if we start to cut the cash ISA allowance, potentially they say it could mean there will be a drop in the choice of mortgages out there, and maybe potentially see mortgage rates go up. So every budget we get the same story of the changes to pension tax relief. If it happens, I'll be somewhat amazed, but we often get the call for a flat rate of pension tax relief. So when you put money in a pension, then you get income tax relief at your highest marginal rate. So a flat rate of 30% would save billions of pounds, and it would be something that could potentially be politically positive as well, as it would be seen to be impacting the richest in society. So one of the rumours that has caused a lot of people to start pulling money out of their pensions is the rumour that there could be a reduction to the 25% tax-free cash lump sum that people can take from their pensions. So there you go, Andy. That's a roundup of all of the rumours that have been put out there as to what might be in the budget on the 26th of November. It goes without saying, if there are any more credible thoughts or rumours, then we will cover them on our social media channels. I just want to say, though, that you shouldn't knee-jerk react and start to make decisions on your finances based upon rumours, because you can end up, especially with pensions, making decisions that can't be unwound that could impact your retirement.